Here. So today we have a bunch of company-specific questions from subscribers, but first I'd like to ask you about the macro, given how interesting things have become, but more specifically I'd like to know about inflation. I mean, it's a very hot topic.
Sure. Yeah. I would say on the macro environment, my thoughts haven't changed since the first time we shot a full-length video like this. And at that time, I said that valuations were high. And today I'd say they're also high. High to very high is what I would say. And then as for inflation, the debate right now is whether inflation is transitory or whether it's sticky. And I don't know which one it will end up being. On the one hand, you have dozens of articles or headlines every week saying it's sticky or talking about something that indicates that it's sticky. And then on the other hand, you have the bond market at least implying that it's transitory based on the 10-year yields around, say, 1.5% or thereabouts. So that's the dichotomy, and there you have it in a nutshell.
Yeah, I mean, it certainly is. So, I mean, if I had to put you on the spot and say sticky versus transitory, which would you say?
Uh, I think I would say sticky, and I would say it's probably going to get worse. Well, what I would say is the risk from a policymaker's point of view is that it runs away on you. So I don't think the downside risk at this point is deflation. So if I were the Federal Reserve or the Bank of Canada or England or whoever, I would be more worried about it running away because inflation doesn't kind of progress or chug along in a lockstep. It spikes when it goes. So that to me looks like the risk, and I don't know if it will happen. The chart doesn't look that good, but I wouldn't be as sanguine as the central bankers currently are. So that's just my take. And to be honest, I try not to put too much stock in my own macro prognostications or that of others really. So that is what it is there.
Yeah, true. Right? So, I mean, in terms of not putting a lot of stock in those prognostications, I mean, could you speak to that a little bit more, maybe?
Yeah, I mean, macro is really hard. No two ways about it. Macro has a ton of variables that go into it. And if you get any of those variables wrong by a large degree, the whole theory is thrown off. So macro calls are often wrong by people out there. And my macro calls haven't been that great either. So plain and simple, it's hard. I don't have a very good track record of it myself. So I try not to put much stock in it. It's exciting and fun, I guess, to think macro, but I try not to get overly involved with it.
Yeah. No, I agree. I mean, some of the brightest minds I follow have got it pretty wrong lately with COVID and whatnot. So
Yeah.
that being said, I mean, you manage a portfolio, so how do you factor that in? Or how do you
Yeah,
manage?
that's a fair question and a very good question. You're right, and you have to think about it at some level or try to do something about it. And as you know, I'm more of a bottom up investor, which helps a little bit. My goal also with my portfolio and my money is to make sure that if I get the macro call wrong, I won't be killed. That's very important, not to be killed. And this means that my portfolio will grow more slowly than the person who really nails the macro call. The person who gets the macro call right will do much better, but the people who get it wrong will do much worse than I will. So I'll land somewhere in between, and it means I can keep going. So this year, for example, I've made two purchases for the vice president's portfolio here, Contra the Herd, and both of those purchases had inflation in mind, or an inflation background, or a worse inflation environment was part of the thesis for buying both of them. But if I'm wrong, I think both of them will be fine if inflation decreases and it doesn't pan out the way that the sticky camp thinks it will.
So if inflation is sticky, how many positions in the portfolio would you say are strong inflation hedges or have some element of inflation protection?
That's a great question. So, what I would say is we own a REIT, and a REIT should be able to pass along rent increases on an annual basis. We own financials and some insurance companies, and those financials should be able to price better in a rising rate environment. We own a handful of miners, industrial companies, a construction company, all of which should also do okay to good, I would say. And then we have a few positions where on the spot, I wouldn't know either way. They're like consumer good companies. And then we own a utility and a telecom. And my guess is that those would be the two or the names and the sectors that wouldn't fare as well because they're highly regulated, and it takes time to pass on consumer price increases. If you're a telecom company, your customers are locked into a fixed contract for a while, and if you're a utility, the regulators aren't going to just be right there for you, increasing the amount you can charge all the time. So that's what I would say there. I would also mention that while I have about 2/3 invested in stocks, about 1/3 of my portfolio, which is a little high, is actually in cash. And the thinking there is valuations are high. So whether it's valuation compression because inflation runs hot, or valuation compression just because there's a blow off in the market, I think owning a bit of cash is not a bad idea.
Okay. Yep. Good plan there. Just thinking of the utilities. I mean, the other risk is interest rates rising because they carry a lot of debt as well. But okay, so with regard to that cash position, I'm just thinking. I mean, in terms of inflation, I mean, are you concerned about that at all? Being a drag.
Sort of. I mean, if I have cash, which I do, the inflation will erode the purchasing power of that money if I were to go out and spend it on goods. But inflation will eventually, if it stays at the current level or increases, will eventually force central banks to increase interest rates. And that will increase the capital costs for companies. It will make it harder for them to earn money and erode their corporate earnings power. And then valuations will likely compress. The environment becomes more uncertain in high inflationary environments. So my anticipation would be that valuations would compress. And it's a case in so many things in economics. It's a case of being damned either way. You hold cash and you lose your purchasing power. You hold stocks and you watch their earnings power slowly eat away, and the valuations get eaten away too. So if the topic of inflation persists, what I would say is that our subscribers will be the first to know our thoughts on it, because naturally we will start writing more and more about it in relation to our investments in each quarterly edition of Contra the Herd.
Sure. Okay. Well, that's great to know.